All right, good morning, everybody. Welcome to Market Eyes Meet the CEO series. Today we have Sam Riggall, who is Managing Director and CEO of Sunrise Energy Metals, to present to you. Before I hand over to Sam, just a little bit of housekeeping. There will be some question and answer session at the end of the presentation. To lodge a question, please use the Q&A facility at the bottom of your screen. Type a question in and then I will read that one out to Sam. With that introduction, I'll hand across to you.
Thanks, Craig. Good morning, everyone. Welcome, and thanks for taking the time to be with us today. Presentation materials were circulated in advance of the session today, so if you don't have them, a copy is available with our ASX filings and on our website. So look, today I want to take you through quite a brief presentation about where we are with the Sunrise project, some of the things we're seeing in the market, and what to me looks like a fundamentally different market to the one we were dealing with only 6 to 12 months ago. And very happy, as Craig said, to take some questions about that at the end. Obviously, read at your leisure our cautionary statement and disclaimers. I always put this one up. This has been our statement since the journey began with the Sunrise project, and our mission hasn't wavered. And you'll see as we talk through, I guess, some of the elements of our project, how we've incorporated our mission directly into delivering the Sunrise project with a design and engineering solution that's really tailored for the battery industry and clever solutions for delivering on the decarbonisation objectives in our industry. And this is extremely important, and it's becoming certainly more important as we engage with industry partners down the supply chain. Just a short recap for those of you who aren't that familiar with our project. The Sunrise Battery Materials Project in New South Wales is the country's most advanced battery materials project. There's been about $250 million invested in the asset to date through resource development, studies, piloting and demonstration campaigns, permitting and approvals. It is a very advanced project. As I said at the start, we've thought very hard about how to design and develop this. It's one of the few fully integrated mine development projects going from ore resource exploitation through to production of battery grade materials, in this case nickel and cobalt sulfate for battery cathodes. It's been designed to run on 100% renewable power, responsible waste management, which adheres to both Australian and international standards. It's going to be a very low cost producer, and it has numerous options both in terms of expansion, integration downstream in precursor manufacturing, and the incorporation of black mass recycling in its process flow streams to add an exceptional amount of additional value over what is a very long-lived multi-decade asset. And at the moment, we're very actively engaged with strategic partners for funding and offtake. Those discussions are progressing, and it's certainly one of the elements that we've seen accelerate over the last 6 months in this industry. This is, as I said, one of the few development-ready assets in the industry. It sits about 350 kilometres west of Sydney. It's in an established mining jurisdiction in the Lachlan Fold Belt. It's construction ready, and as I said, there's been extensive piloting and test work done to date. We are ready to build. It's supported by significant infrastructure, rail, road, port facilities, energy infrastructure, and from final investment decision, which would be post-financing to first production, we're looking at roughly a 3-year construction period. But this is as good as a location as you will find for any battery material project in the world, particularly for the sorts of metals we will be producing in nickel and cobalt. I often try to emphasize why this is quite an unusual ore body. and I'm benchmarking Sunrise here against operating nickel hydromet plants around the world. Many of these are in Southeast Asia or the Pacific. Those latitudes at which you get typically oxidized nickel resources, where hydromet processing solutions are important. But you can see here, when we plot the cobalt to nickel ratio, this is an unusual ore body due to its cobalt content. It also contains very low levels of clay materials. When you look at a tropical laterite, you typically find very wet clay hosted material that presents really significant handling challenges and material handling challenges through the process, and also is quite aggressive on acid consumption, which is one of your major cost components. About a quarter to a third of your operating costs at a nickel hydromet operation are in acid consumption. It is as I say, and you can see from this graph, it is very cobalt rich, and it's the cobalt credits that deliver the very low cash nickel equivalent cash cost here. So, if you convert the grades at Sunrise to a nickel equivalent grade, you're probably talking about something in the order of 1.5 to 2% nickel being processed into the mill. So it's very high value ore. Our project execution plan, which was our most recent bankable feasibility study, was released at the end of 2020. It forecasts, on average, over the first decade of operation, about 20,000 tonnes of nickel production and about 4,500 tonnes of cobalt production annually. Very strong economics based on its cash operating position, an NPV of about 1.2 billion US, or in today's Aussie dollars, about 1.7 billion, an IRR of a bit over 15%, a capital estimate of 1.8 billion US to build, which translates to a payback of about 5 years on what is a 50-year asset. So, a very good payback, very strong IRRs. It generates exceptional cash flow, and on a nickel equivalent basis, after byproduct credits, that is, you're looking at a negative nickel cash cost producer, negative 80 cents a pound nickel. And again, back to the cobalt, most of that that cash cost position is driven by the very high and large cobalt credits that the mine will spit out. So where are we at the moment in terms of our approach to development? Financing is the focus. This supports a conventional project financing approach. I think it's important to emphasize, although the supply chains here that we're looking to supply materials in are relatively new and forming, and in that sense, I mean the electric vehicle supply chains, battery supply chains. There's nothing special we need to do here to finance this project. This is a conventional non-recourse project debt financing approach that you would find at any large mining project globally. We have 4 mandated lead arrangers. We're targeting about 50% of the project's funding requirements through a conventional project debt facility. In addition, governments are quite active at the moment in looking to support projects. We've already announced that Export Finance Australia has indicated conditional support for up to $400 million for the project. We've also met with a number of international export credit agencies. We've also confirmed that there is strong support from them in terms of not just attracting content in the project that would be, I guess, local to their ECA financing, but also being able to secure the material for the jurisdictions in which they operate. So, look, there's no shortage of debt, in summary, for this project. In fact, you could probably almost build it all with debt based on what we think is available to fund. But we do need to bring equity into the project as well, and that's really where the focus is at the moment. And as we say here, discussions are underway, have been now for some time, with potential industrial partners. And at this stage, the focus is very much around the offtake and the investment necessary to secure that offtake. The investment is envisaged to come in at project level. We are going to try and create a joint venture that will integrate directly into an electric vehicle or automotive supply chain. And that to us is where the future is heading. And I want to probably say a few more words about that now. I've been asked today maybe just to touch briefly on what the Ukraine-Russia situation means for some of these metals. It obviously has forced a really sharp rethink on certain commodity markets. Nickel is definitely one of them. And as we say here, Russian supply accounts for about 20% of global Class 1 nickel production. However, as yet, Russian nickel and the Russian companies that produce it remain unsanctioned. And if anything, that I think goes to highlight how strong Russia's position in this market is globally, and the paucity of other options that exist for supply if Russian supply wasn't there. I love this picture because it doesn't just speak to the geopolitics and the problems with supply chains, but to me it's also representative of probably where the mining industry started at one end of the table, with the automotive industry at the other end. That table is actually becoming much shorter now in those discussions. And I think, over the next few years, whether it's with us or with other development companies in the raw materials space, you'll start to see some very significant announcements about integration of raw materials into EV supply chains. And that is expected. So in summary, Russia has had an impact, but I think it's also dangerous to overstate the size of that impact. For a number of years, we've actually been seeing these risks coalescing around electric vehicle supply chains, battery supply chains. And as I've discussed with many of you before who are on the call, some of that relates to reputational risk, particularly for cobalt and nickel supply. But part of it also relates to operational risk. And this is a risk that wasn't well understood for quite some time, not even by car makers. And a lot of it is driven by the concentration of supply for some of these key metals. Lithium's a bit more diverse in terms of its supply sources, and in terms of geopolitical risk, probably more manageable. Not always, but in general, yes. But when you come to nickel and cobalt, operational risk is a real challenge. And here we've got, I guess, world shares of production from primary extraction. So in nickel, you can see obviously Indonesia will, by the end of this decade, have a very, very large share, as will the DRC continue to have a very large share on cobalt. But the point to make is that it's not just primary extraction that's the problem. When you look at secondary processing, most of that raw material expansion in Indonesia, or what we're forecasting in the Congo, will mostly be Chinese funded. So you're still looking at a very long and strong lock that China will have on secondary processing of materials in this industry for quite some time to come, unless we start to see alternative sources of supply emerging. I've spent quite a bit of time in the US looking and speaking to companies about various supply chain options. I like to set out what specifically commitments are being made in the US around the various supply chains that are emerging there. Ultium is the GM supply chain. SK and Ford obviously have their own views on what they will build. Tesla's sort of storming ahead, and then you have a bunch of others. But these are all the announcements that have been made around cell plant capacity, the suppliers for the feedstocks, the cell capacity within the next 5 years, 4 to 5 years roughly, in terms of gigawatt hours, and then what that translates to in forecast metal requirements. So just for the US alone, we are looking at somewhere in the order of, let's say, 350,000 tonnes of new Class 1 nickel capacity required, and about 40,000 tonnes of cobalt capacity. Interesting to note that a lot of this capacity is already committed as NCM. There's virtually no LFP capacity in the US announced today. There are good reasons for that, and a lot of investors are focused on this technological transition between NCM and LFP. But I can assure you, at least in our discussions, NCM isn't going anywhere very quickly. It is the fastest route to battery material for the car industry. It continues, particularly with cobalt, to provide a lot of assurance around safety and life cycle for these products that are being produced, and will therefore continue to be used, albeit at a thrifted level. But I think when you look at just what the US needs, and then you factor in what China needs, when you factor in what Europe needs, what Southeast Asia needs, and we've been saying this for years, it's a drumbeat that Robert Friedland has been delivering probably for 4 or 5 years now. As chairman of our company, there is just not enough metal to meet what the car industry needs. There are going to be some very significant winners and losers in the way this supply chain reorients itself over the next few years. As I said, we look at this as a game of musical chairs, and some car makers will be left without a seat. You will start to see some large announcements, as I've said, I think over the next 6 to 12 months, and then it's probably game on. I always like to impress that Tesla's Gigafactory, while very impressive, was not really the first Gigafactory. The first Gigafactory in the automotive industry is this one. This is the Rouge plant that Henry Ford built in the early 1900s. It was the most integrated and largest industrial plant in the world at the time. They imported coal, they imported iron ore, they imported rubber, they imported base metals, so that every part of the supply chain could be controlled to serve what was the ultimate objective, which was the speed of industrial production. The Ford Motor Company took the production of the Model T from 18 hours for a single car to less than 12 minutes. And they could only achieve that with extensive levels of vertical integration. So we have been here before. It's the natural evolution of an industry that changes. We go through these transitions, and it doesn't last forever. As supply chains mature, as you start to see supply respond to demand and alternative sources of supply opening up, you do start to see a move back to less vertical integration, but that is a process that can sometimes take decades. And this was a path that many of the major automakers followed in their early years, and it's the path that many of them will have to follow today when they are converting to electrification of the drivetrain. That the key metals are the foundation on which all of these technologies are built on now. And I'm not just talking the propulsion systems, it's the software systems that will run the car as well. It'll be the autonomous driving systems. You can't enable any of that without the energy storage capability that these metals provide. And it's not simply a question of supply risk. As I've said, I believe there won't be enough metal, but it's also a question of pricing risk. And how do you control pricing? How do you hedge against the extreme volatility that these metals show? The only real way to do it is through, we believe, ownership. ESG is emerging as probably the key, criteria that many companies in the supply chain are using to evaluate their supply options. I've said here, nickel target of 10 is possible. By that I mean 10 units of carbon dioxide equivalent for every unit of metal you get out of the ground. This is for nickel. Nickel is extremely important for your carbon footprint. I'll show why in a second, but we believe 10 is possible. In Sunrise, we've designed everything around getting that carbon footprint down. we're a fraction over 10. I think we run at about 12 kilograms CO2 equivalent for every kilogram of nickel, but you can see the wide variety of carbon impacts from different production processes. Class 2 nickel, it may ultimately be abundant, but it has a lot of issues in terms of its carbon content that I think will slow its adoption in the supply chain ultimately. But we've done a lot of work around Sunrise. We've done a lot of work around the renewable power options. We believe that we can deliver a very good outcome to the automotive industry. And it's important because when you look at the energy intensity of metal production, I mean, for those of you who are familiar with the mining industry, even those of you who aren't, we all know that aluminum is often referred to as congealed electricity. I mean, it is that power intensive to produce. People rarely give thought to how much energy goes into producing a unit of nickel. And again, this is a really great demonstration of why, if car makers can't get their carbon footprint right around nickel, you're not going to have the carbon impact that you wish to achieve in building your electric vehicles. So it's those scope 3 emissions that car makers will be very focused on in thinking about where their nickel is produced, what sort of energy intensity does it have, and what does the carbon impact mean. Just as I come to an end, I don't want us to not mention what I call the forgotten metal, scandium. This is a byproduct in our process. We will be producing a lot of scandium. It's a relatively nascent market, but we believe that with the significant volumes that we will produce at Sunrise, there is enormous upside here for building really critical markets. This is a rare earth that is proving to be indispensable in a couple of key applications that are emerging now. Some of them relate to energy production. Solid oxide fuel cells, for example, have been well known for a long time. Not so much hydrogen electrolyzers. That's another area that seems to be of great interest. In 5G and 6G telecommunications, many of the cell phones that are on the market today contain scandium used in piezoelectric targets, really critical for 5G and 6G communications, both for civilian and military applications. And obviously, the one we've always focused on is in alloys. Really pleasingly in the US at the moment, our partnership with Relativity is progressing really well. We've done a lot of work to help build them a domestic supply chain for alloys that they can use to 3D print their rockets. And we're hoping this year sometime to see the first launch of those rockets. And if you can deliver the economic benefits through printing 3D printable rockets for satellite launch, I think the objective of slashing the cost of some of these aerospace technologies is well within reach. So scandium plays a really critical role, we believe, in delivering that. It's one of the few alloys that allows us to 3D print aluminum. So it's certainly not forgotten by us. We're doing a lot of work here, and it's certainly a very strong area of focus for jurisdictions like the United States, where rare earths and their applications in defence and military applications is of high priority. So look, in summary, this is an important project because it is one of the most advanced in the world that has a growing exposure to what is going to be one of the largest industrial shifts, the transition to renewable energy. We're seeing the early stages of that through electric vehicles, but don't forget that it will also come through grid scale energy storage solutions as well, and a range of other applications where these batteries are going to be used. We're in a great location. We are ready to build, and it has very strong economics, this project. Everything in our design has been focused on delivering a sustainable project that will have industry-leading carbon emission performance. We're very focused on water. That's been the ethos of a part of what was formerly Cleantech for many years and is now Sunrise Energy Metals. but we are trying to develop something that also has longer term optionality. With a 50-year resource life, we have numerous what we believe are low-cost expansion options in the future available to us. We've got the options to look at incorporating precursor and recycling, and we continue to drill out more cobalt in the region at the moment. With cobalt mineralisation, we've been very aggressive in putting our foot on more ground in the Macquarie Arc. So we don't see this as simply a mining project that will deliver a few years of good upside. This will be the hub of what will eventually be a very large industrial centre focused on producing battery raw materials for Western world markets. So thanks, Craig. I'll leave it at that, and happy to take questions if there are any.
Thanks, Sam. Just a reminder to everyone, use the Q&A facility at the bottom of your screen to type your question in, and I will read it out to Sam. Sam, first question, and there's a few of these just around offtake. How do you think about offtake with a multi-product mine? So you've got nickel, you've got cobalt, you've got scandium. You're going to require offtake for all three, or the prime focus is on looking at nickel offtake?
No, I guess the industries we're focused on are automotive and battery production or cell production. They need the nickel and the cobalt. So it would probably be done as a package. Scandium's a bit more bespoke in that different industries involved. But look, once the nickel and cobalt is in production, then we've got sort of significant options for where we place that material in the market. But no, look, my expectation is that given the amount of metal or the level of demand we're seeing from industrial partners, it's likely to be one or two offtake partners will do it all.
Yeah. With those conversations that you've been having with those potential offtake partners, and given the recent price volatility we've seen, in particular with LME nickel prices, are the OEMs seeking to lock in sort of alternative pricing structures? Are we looking at sort of fixed pricing range, or most of the discussions you're having are around pricing benchmark to LME?
Yeah, it's a good question. As I mentioned before, there are two elements to risk. One is getting the material in the first place. The other is once you've got it, how do you manage pricing volatility? Look, the car makers and the battery manufacturers are pretty uncomfortable at the moment with where raw material prices are. The focus very much for the car industry is to be able to launch, their inaugural or new range of electric vehicles at a price point that can effectively compete with an internal combustion engine. And raw materials are a really important component of that. So yes, discussions do turn pretty quickly to what are the mechanisms available for managing some of that price risk. On the volumes that many of them are talking about, standard third-party hedging arrangements just aren't available for the sorts of volumes that we're discussing here. Liquidity on the LME, for example, is far too low to try and hedge forward positions on that volume of metal. So yes, they are looking for, I guess, some fresh thinking from the mining industry around that. Our position typically is that in our industry, the market dictates pricing for these materials. It always has. It's one of the benefits of having terminal markets. There's always somewhere to sell your product at the end of the day, even if it's into a warehouse. And that does keep, I guess, the discussion focused on market pricing. But look, there are a range of issues to consider with projects of this scale. One obviously is debt funding, and to the extent that banks get comfort from pricing arrangements that underwrite the risk for a project, that might be something that you would consider in terms of pricing. But look, in general, I'm speaking as someone who's spent most of their career in the mining industry. I like the volatility that metal prices bring. It means you do live with some pain through the cycles, but you make all of your money and multiples more when things are very good. And that's what investors invest in us for. But I think the reason I said it's a very good question is that I think over the long term, that as you start to see car companies vertically integrating back into raw materials, it's that sort of volatility that they'll find very uncomfortable. And I think as an industry, mining industry, we are going to have to think very hard about how we manage some of those pricing risk discussions and structures over time, because the first thing that should be in our minds is how do we build a sustainable electric vehicle industry that delivers the cost points where people can afford these cars and that they have a bright future and that they continue to require the metals and we can produce those metals sustainably. So yeah, look, we'll see. I think, as I say, there are lots of structures being discussed, but I guess those are the considerations I've just described that we're thinking about as we negotiate.
You've mentioned that vertical integration a couple of times. Is it fair to say then that it's the ball's really in the auto manufacturers and the battery materials court? You know what you want as a company in terms of the funding and the pricing structure, and it's just waiting for them to, I guess, make the decision or see the change in the macro market to execute?
Yeah, it is. The ball is very much in their court. Look, I've got a headache. I've been bashing my head against a brick wall for 4 years, talking about this to anyone who would listen, including the car companies. Look, in the last 6 months, the world has changed fundamentally in terms of their outlook for how they now need to build their supply chains. I won't talk about specifics, but the industry as a general, and we speak to almost all of the major automakers, they all now have a strategy for raw materials and how they're going to execute on that. There are probably differences in degree on how they want to integrate and I guess the depth of that integration. And as yet, we haven't really seen anyone put serious money on the table. I mean, we see lots of headlines from Tesla, being proactive, but even Tesla hasn't really put any serious money down. They've announced many offtakes, which I find interesting as the company that is probably most exposed, given their growth projections, to metal supply. They're building a foundation. They're building a business model on a pretty shaky foundation at the moment, and they may be one of the first to step into this area. But look, I guess I've got a headache from the last 4 years, but I'm also, I think, quietly pleased that, I think the industry has sort of moved to seeing our view of the world, and it's only going to get more bleak for them the longer they leave it. So, it's nice to be right, but maybe we moved about 5 years too early. That's the cost, but the upside now is we're ready to build too. So we've done all the hard yards. When a car maker looks around the world to find a project that is low risk, is low carbon, they can execute on immediately for the metal they need in the next few years, there's not a plethora of options to grab for. You've probably got 1 or 2 globally that are ready to go now.
Yeah. And if we are going to see, auto companies, I believe GM have made some noise around this lately about investing directly into mines. How important is it for the OEMs and the auto industry to be investing into mines that are located in safe jurisdictions or politically safe jurisdictions, and how much of an advantage is something like Sunrise, A, from a technological standpoint, but B, sourcing that renewable power? Is that sort of putting you at the forefront of those conversations in that vertical integration?
It is. And look, I've been saying for quite some time, first priority is cost. It always has to be. We need to be cost competitive in this industry. Second order priority is the ESG performance of what we have. And that's certainly the way the automotive industry sees it, cost, ESG. But I would say that the focus in the last 6 months has really swung strongly to ESG. It's not that they're discounting cost, but as they've looked around in the last 12 months at what the options are, I think many of them have been quite shocked. It's been the first experience many of them had stepping into the mining industry, stepping onto a mining site. If you do it in Africa, if you do it in Southeast Asia, it's a very different experience to doing it somewhere just outside Sydney, or doing it somewhere in Australia. So yes, we benefit enormously from where we are located, and the infrastructure that's available to support what we want to build. So ESG is going to be critical. You know, is it always going to be driving the decision of the car maker? No. We've seen, for example, Volkswagen in the last couple of months announced that its strategy is very, very much tied to working with China in Indonesia. Now that's the decision they've taken. You know, how that works out for them is yet to be seen, but I think that will be a challenging environment to work in. You've got other joint ventures like BASF still have their partnership with Nornickel, the Russian nickel producer, and so far BASF doesn't see any need to sort of step away from that arrangement. So I think there are different parties taking different views in the industry about how much reputational risk they want to take on, but the vast majority, at least of Western automakers we speak to, desperately looking for jurisdictions that present low geopolitical risk for them and low operating risk.
Yeah. We've talked a bit around sort of ESG with the OEMs and the car industry investing into you know, potentially coming on board with Sunrise. What are we seeing from ESG funds and ethical investment funds? Are you seeing a renewed interest in Sunrise because of its position in that global supply chain for electric vehicles, decarbonisation, or is it a little bit too soon for that yet?
Yeah, look, to be honest, for us, our sole focus has been the industrial partner, and you know, we've been quite clear early on that the solution to financing Sunrise isn't to go into public capital markets and raise equity there. It's going to be building a long-term relationship with an industrial partner that catalyses, I guess, first production and then ultimately the expansion options for the plant. I guess when we engage with investors, particularly those in the ESG space, there is an intense interest around, I guess, the raw materials piece now. But having said that, I think one of the challenges for raw materials is that financing is still the biggest hurdle. And again, we shouldn't generalize here. I think the lithium space, you have many more options for investment, more projects globally, and public equity markets prepared to back it. That's always the way. That lithium tends to be the leading indicator in these cycles. But when you start talking about capital intensive, large scale, remote nickel, cobalt, laterite projects, it's a very, very different prospect. With the exception of China, who's building them at a gangbuster rate in Indonesia at the moment, there's nothing else being built globally. And that's just not sustainable if the Western auto industry wants to build electric cars. So there's going to have to be a big swing back in momentum to where capital gets allocated. Private equity is certainly kicking the tires very hard, looking at assets in this space. But again, probably the lead times for both development, construction, and then commissioning and ramp up of these projects, you know, it's a long process for private equity. I think, and I've said this for some time, that if you're going to start swinging that pendulum to free up capital into Western-oriented projects, then government's going to have to play a very big role. And we're starting to see that in the US. Defence Production Act legislation is now before Congress to free up a lot of potential capital to really get projects moving. Europe's doing exactly the same thing. And I think the message we try to deliver on this is that governments are not here to fund projects. We think that's a mistake. Governments should either be regulators or owners, but not both. We'd rather see them as regulators. But there is something governments can do to unlock private capital, and whether it's commercial debt markets, whether it's ECA funding, whether it's equity, there's a bit of risk sharing that can be done around projects like Sunrise that will unlock a lot of capability in that debt and equity market that currently sort of is sitting on the sideline at the moment. And you know, it's first steps, but I think that's where the industry will head over the next few years.
Yeah, interesting point there with governments. When we saw earlier this year, I think it was $400 million worth of support for the Sunrise project from Export Finance Australia. What sort of conversations and support are you having from other agencies, both here and offshore, similar to Export Finance, who could be coming on board to provide some capital for the project development?
Yeah, so our focus, I guess, on other markets for ECA are obviously US-based and European-based. We think those markets are probably the logical home for Sunrise production. On the US side, as I said, the US government is now really stepping up its efforts around things like Defence Production Act. We'll see what they do with Development Finance Corporation. US EXIM has a very progressive program around China competition and transformational exports programs that really fit what we are trying to do very closely. So, you know, the US, I think, is moving definitely in the right direction. US programs for ECA support are quite interesting. They're much more focused on import rather than export. In other words, what they want to see as a condition of funding support for projects is there's a lot of US content in the project, whether that's US steel, US engineering support, all the things that, you know, a typical ECA would look for. When you go to Europe and look at the programs they run there, they're much more export focused. So it almost doesn't matter whether you have German or French or you know, Italian content in the project. All they're concerned about is where does the production end up and where is it exported to. And again, there are vast pools of funding under various programs in Europe that fit really well with what we are trying to do. You know, ultimately, it's all going to come down to the partner we have. If it's a European partner, I would expect that we will be looking for you know, quite a bit of ECA support out of Europe. If it's a US partner, it'll be out of the US. But there's no doubt that there's a lot of capital there to support projects like Sunrise going forward.
Yeah. Inflation raising interest rates around the world, is that posing any, I guess, risks at the moment, or any change in people's thoughts, or it's just a blip on the radar?
Well, look, yeah, it's certainly forefront of our thoughts, particularly inflation. You know, we have a capital estimate that obviously will escalate with inflation, and we sort of look at that. It hasn't had, if you take, I guess, the Australian numbers, inflation numbers, it hasn't had a material impact ultimately on the final capital cost. As we engage, though, with construction contractors, the issues that are really, I think, more at the forefront of people's minds are supply chains and getting equipment and hitting schedules. It's the bottlenecks in supply chains at the moment that are feeding into some of that inflationary pressure, but also, I guess, requiring a rethink of how you execute on projects at the moment. So yes, we think about this every day. Yes, in our execution plan, we will revisit how all that gets delivered. But you know, I think we feel relatively comfortable that sort of from the capital side, you know, it's still very much manageable for the sorts of equity funding we're looking. You know, we'll be covered to build it.
Yeah. You mentioned supply chains, and there's a very specific question here, so that's a nice little segue into that one. What's the status of the engineering work on the route for the heavy equipment to the Sunrise project?
Yeah, good question. So for big plants, we're going to have to bring things into port and then get them up to site for construction. And some of that will include prefab parts of the circuit. So, you know, partially constructed offshore. It does mean that from port to site, you need a relatively meaningful transport window or corridor or envelope to get the material up to site. So we're working very closely with local councils and the roads authorities. We have a couple of different areas where we can bring material in through. Could come through New South Wales. It can come through South Australia. In the case of our autoclaves, for example, they're already in South Australia. we'll have to bring them up through that route. It requires, potential modifications to roundabouts, to power lines, to bridge crossings, all those things. So that's a piece of work that was scoped under the bankable study. And since the bankable study was released, we've been continually working on that to get those transport routes, defined, and working with councils to deliver on them. So yes, it's work in progress.
Right. Conscious of time, we've probably got 5 more questions to get through. Couple on scandium. First one, is any test work being done on scandium out of the deposit? And if so, roughly what recovery rates are you expecting to get out of the deposit?
Yeah, all of the piloting campaigns we ran included a scandium recovery circuit. So we have pulled scandium. I'm sorry, I can't recall the recovery rates. It was quite high, but in the PEP we explained, in the last bankable study, we explained that if we were to recover all the scandium that's coming through as byproduct in the nickel and cobalt production, we'd have circa about 180 tonnes of scandium oxide through nameplate capacity. So that's a lot given the size of today's market. The intention is only to build a scandium recovery circuit initially that will pull roughly half that, so about 90 tonnes a year. That's still a lot of material. And we left open the option to either build that later, so it could be year 3 or 4 after commissioning, or if we were confident that we had a market for all of this material, we'd start it straight away. So we've left options for scandium, but the recoveries are relatively high using ion exchange. The question is, though, is just how much we decide to pull, and that's going to be driven by, I guess, the view of the market and how much it needs to absorb.
Yeah. Question on the expandable options of the project. So assuming we get into production, hit the steady state, what are the expansion options for the project in sort of years 5, 10 and beyond?
Yeah, we, in the release of the PEP, we flagged this at the back of the study that in all of the design and engineering, everything downstream of the autoclaves has been designed with a view to future expansion. So we've left space. You'll find extra concrete pads sitting there empty. You'll find the way we've designed, for example, the IX circuit allows us to put more pachucas in. Because the reason we took that approach is that our autoclaves are slightly oversized for our initial planned throughput of about 2.5 million tonnes a year. We've probably got a bit over 3 million tonnes of capacity in those autoclaves. The only thing that's needed to enable us to go to 3 million tonnes is an approval from the government amending our development consent. So, but what we wanted to leave open was the option to put more plant in at relatively cheap cost. I think we costed it at around a bit over $100 million for that additional capital to expand downstream of the autoclaves. And that would allow, I think it almost added another $500 million of NPV. It's a low cost, easy expansion because we have the autoclave capacity available. When we want to double the plant production, rather than adding another 20 to 30%, then it requires a much larger capital commitment. It will be duplicating autoclaves. It will be running a 3rd and 4th train for the plant. And that probably is a year 5 or 6 decision at that point, when probably you're hitting peak nickel and cobalt production for that first decade. So, we haven't done a study on capital cost for expansion, but given the size of the resource and the fact that we think we'll continue to expand it over time, we believe that if you want to support 1 million cars, electric cars, out of this operation, you can probably achieve it.
Yeah. 2 questions. Second last one is human capital. How is Sunrise placed with staffing and accessing people, and how tight do you think that market will be in Australia when it comes time to develop the project?
Yeah, the market is definitely tight at the moment. How it's going to be when we start the projects, look, that's something we have addressed in, again, the project execution plan. There's an operational readiness plan in there. So the initial priority will be to build the owners team internally, get the EPCM stood up and get into construction. But at some point during that construction phase, we're going to be flipping into thinking about operations readiness and start recruiting the operations team at that point. They will be the team responsible ultimately for getting the commissioning up and running, and then flipping over directly into operations once we've hit commercial production. So look, there's a larger issue here in terms of, are we producing enough graduates in Australia to service what is going to be a very fast growing industry? We expect that we're going to have to do a bit of the heavy lifting ourselves around training. But the beauty of where we sit is that we have a workforce in this part of New South Wales that is intimately familiar with mining. They're very supportive of mining, as are the community, and it's a very well-trained workforce for mine sites and processing plants. So, you know, we'll be drawing heavily, at least from that community to start with, but we'll have to build it over time.
Great, thanks, Sam. Last question. This has been posed many times in different ways in the chat. But will existing shareholders be given an opportunity to participate in the financing of the project when the time comes?
In my perfect world, I don't have to go back to shareholders to finance this. You know, I'm very much focused on trying to find an industrial partner who will bring the balance sheet strength to do it. Part of it will also depend on the size of the debt capacity we bring in to support construction. If we do have to go back to market, I don't expect it would be a large raise. We might need some capital, for example, to you know, build the owners team up again and run, you know, overheads for construction and the delivery phase of the project. But at the moment, I'm just very much focused on putting together a financing package that is a comprehensive package for financing. So I can't say whether we'll be back to the market to raise capital again. I think we've got roughly 30 million in the bank today, somewhere around that, which is, you know, perfectly adequate for the work we're doing at the moment.
Great, thanks, Sam. That's the questions. I very much appreciate your time, and I'll hand back to you for any final remarks.
No, look, just thank you. And for those shareholders who are on the line, thank you for your loyalty and your patience. That patience will be rewarded. As I said, we probably started this a lot earlier than most companies in the industry, but we're very well placed now. And that's obvious as you progress through commercial discussions and as companies, you know, do due diligence and try to understand what they're looking at. We're extremely well placed with the work that's been done around the engineering and the design, the environmental and sustainability credentials of the project. So look, just watch this space. As I say, whether it's us or others, in the next 6 to 12 months, I expect it's going to get very busy.
Great. Thanks, Sam.
Thanks, Craig. Thank you, everyone.